Hey everyone, welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and in today's episode, we're diving into the absolute essentials every trader needs to master: how to read economic calendars, interpret Fed minutes, understand stock charts, and find the best data sources that real traders rely on. If you're looking to get sharper in your trades and stop relying on guesswork or hype, this episode is for you. We're going deep, and by the end, you'll be equipped to read the markets like a pro, using hard data and smart tools. Let's get into it. Segment 1: Reading Economic Calendars for Trading. An economic calendar is hands down one of the most powerful tools in any trader's arsenal. It shows you a day by day, hour by hour lineup of events that can move the market: inflation reports, central bank meetings, jobs data, retail sales, and more. But here's the thing: it's not enough to just look at the calendar. You have to know what to look for and how to respond. So, what should you be paying attention to? First, check the event name. Is it the US CPI report, the ECB interest rate decision, a major jobs report? Then, look at the time and date and make sure it's adjusted to your time zone. Nothing worse than missing a key release because your calendar was in GMT and you're trading from New York. Next, focus on three columns: previous, forecast, and actual. Previous tells you what happened last month or last quarter. Forecast shows what economists and analysts expect this time. Actual is the number that comes out. That actual number is what moves the market, especially if it surprises in either direction. Let me give you an example. Let's say US non-farm payrolls are scheduled for Friday at 8:30 a.m. The forecast is plus 180,000 jobs, but the actual release comes in at plus 250,000. That's a bullish surprise for the US economy. Chances are the dollar strengthens, bond yields climb, and equities might pop depending on context. Now, here's a tip: pay attention to the expected market impact rating. Most economic calendars tag events as low, medium, or high impact. If you're a short-term trader, you want to either avoid trading just before high-impact events or prepare for volatility right after the release. Swing traders and macro-focused traders, you're using this data to confirm trends or spot reversals. Chart increasing, and if you want a platform that doesn't just show you this data, but integrates it with trading tools, real-time charts, and execution, check out the Crystal Ball Markets platform. It's a world-class, cutting-edge, and super user-friendly trading app. I've tested it personally, and it's the kind of platform that actually makes you faster and more confident. Highly recommend checking it out. Segment 2: Understanding Fed minutes and macro reports. All right, next up, let's talk about Fed minutes and macroeconomic reports. Now I know what you're thinking. Fed minutes are boring. And yeah, they're not exactly a page turner. But if you want to understand how markets are really driven, you can't ignore them. Fed minutes give us a behind the scenes look at what the Federal Reserve is actually thinking. They don't just tell you the policy decisions, they show you the debate behind the decision. So how do you read them? Start by scanning for tone shifts. Are the members more hawkish this time? Are they worried about inflation picking up again? Or maybe they're starting to get concerned about economic slowdown. Look at the language. Little phrases matter. If the previous minute said a few participants favored more tightening, and now it says many participants, that's a signal the Fed is shifting more aggressively. Even subtle language tweaks can move markets big time. Also, track mentions of inflation and labor markets. Are they saying inflation is easing? Do they still see wage pressures as a threat? And don't forget about dissent. If certain members are starting to disagree with the majority, it means the consensus is cracking. And that can hint at future changes in direction. Market reactions? Here's a cheat sheet. A hawkish tone usually lifts the dollar and bond yields and might hit tech stocks. A dovish tone tends to boost equities and hurt the dollar. Oh, and reactions can sometimes be delayed. The big money, institutional traders take time to digest these releases. So don't assume if the market doesn't move in the first 5 minutes, it's over. Headphone, and hey, if you want Fed minutes and macro breakdowns explained without the financial jargon, subscribe to the Crystal Ball Markets podcast. They do a fantastic job breaking down trading, macro trends, and investing for beginners in plain English. It's educational and actually fun to listen to. Go check it out. Segment 3: How to read stock charts like a pro. Let's shift gears and talk about something visual: stock charts. If you're trading and not looking at charts, you're flying blind. Simple as that. There are different types of charts: line, bar, and candlestick. Most traders use candlesticks because they pack in the most info. Here are the essentials to look for on a chart. Support and resistance levels are non-negotiable. Support is where buyers step in and the price tends to bounce. Resistance is where sellers step in and push it back down. Trend lines and channels help you visualize the direction of the move. Draw lines across swing highs or swing lows to map out where the price might go next. Next, moving averages. These smooth out price action and help you follow the trend. A 50-day or 200-day moving average is super popular. If price crosses above the 200-day, that's often a bullish signal. Indicators? Keep it simple. RSI shows whether something is overbought or oversold. MACD helps spot momentum shifts. Bollinger Bands show when a market's getting stretched. Great for fade setups. Here's the real trick: zoom out first. Always start with a daily or weekly chart to see the big trend. Then zoom into lower time frames to find your setup. Don't overwhelm yourself with 15 indicators. Pick a few, master them, and stay consistent. Segment 4: Best data sources for traders and analysts. All right, we've covered the how. Now let's talk about the where. Where should you go to get reliable economic data and charts? Here are my go-to sources. FRED, the Federal Reserve Economic Data Site. It's free and it's gold. Trading Economics gives you economic calendars, forecasts, and global data. Investing.com, real-time charts, earnings calendars, and tools. BLS.gov, the U.S. Bureau of Labor Statistics. It's the source for jobs and inflation data. Bloomberg and Reuters for institutional-grade macro and market headlines. And yes, Bloomberg Terminal is expensive, but if you're managing big capital, it's worth it. If you're serious about trading macro or currencies, having access to fast, trustworthy data gives you the edge over 90% of traders out there still relying on headlines and Twitter noise. Final thoughts: don't trade blind. Here's the takeaway: the markets don't reward guessing. They reward discipline, research, and timing. So if you want to grow as a trader, learn how to read an economic calendar. Understand what central banks are signaling. Master stock chart analysis. Use the best data sources to inform your decisions. Direct hit, and if you want to execute your ideas with confidence, go check out the crystalballmarkets.com platform. It's sleek, fast, intuitive, and gives you all the tools you need in one spot. And while you're at it, subscribe to the Crystal Ball Markets podcast. Whether you're brand new to trading or looking to sharpen your edge, it's one of the best podcasts out there. Thanks for hanging out with me today on Financial Market Insights for Traders. I'm Sophia, and I'll catch you in the next episode.